Hello, everyone. Welcome to Talk Talk Speak podcast. Today, we're tackling a critical question. Just how much financial strain are American households under?
It's a big question.
Definitely. We've sifted through the latest data, mostly from the New York Federal Reserve Bank's first quarter 2025 report and some expert analysis from the financial press, too.
Right. Lots of numbers out there.
Exactly. And our mission today is to cut through all that complexity. We want to identify the key signals, the signs of rising financial pressure on consumers.
And figure out what it means for the economy, for investors.
Precisely. So if you're looking for a clear, concise understanding of this really important issue without getting totally bogged down in spreadsheets, well, let's get started.
Okay. So it's pretty remarkable when you just look at the sheer scale of borrowing in the U.S.
Top line number.
Yeah. By the first quarter of 2025, total household debt had surged to a massive $18.20 trillion.
$18 trillion. Wow. And to put that in perspective, right, that's a $167 billion increase in just 3 months.
Just Q1. It's just Q1. And it's a staggering $4.06 trillion more than we saw before the pandemic back at the end of 2019.
$4 trillion higher than pre-pandemic levels.
It really underscores, the significant increase in the financial load American households are managing right now.
Absolutely. And if we drill down a bit, where is this debt concentrated? Mortgages are still the biggest chunk, right?
By far. Mortgages were at $12.8 trillion. And that actually grew by $199 billion just in Q1.
Still growing.
Still growing. Then you've got ETLOCs, the home equity lines of credit. They're now at $402 billion.
Okay.
And what's really noteworthy there is that this marks the 12th consecutive quarter of increases for ELOCs.
12 straight quarters.
12 straight quarters. It seems like a lot of homeowners are, increasingly tapping into their home equity.
That consistent rise, it does prompt a question, doesn't it? Why are homeowners leaning so heavily on home equity?
It really does. It could be, a strategy to consolidate other debts, maybe cover rising living costs. But given the upward trends we're seeing in delinquencies elsewhere, this increasing reliance on home equity, it could become pretty precarious for many, if property values wobble or their income takes a hit.
Right, if that cushion disappears.
Exactly. So definitely a trend to watch closely.
Okay, now the data also showed a decrease in credit card debt in Q1, down to $1.19 trillion, about a $29 billion drop.
Yeah, and we also saw auto loan balances dip slightly, down to $1.64 trillion, a $13 billion reduction.
So initially that might sound positive, like people are finally paying down debt.
Well, you have to be careful there. A dip in credit card and auto balances in Q1, it often happens. People get tax refunds, maybe pay some things off.
The seasonality effect.
Right. So we need to be cautious about jumping to conclusions, especially when you look at the delinquency figures we'll get into.
Okay.
The New York Fed pointed out, even with that quarterly drop, credit card balances were still 6% higher than a year ago.
Year over year, still up.
Still up. And the fact that auto loan balances have only decreased twice since mid-2011, and at the same time, delinquencies in that sector are rising, it suggests a more complex picture.
So maybe not just people paying down debt.
Maybe not. It might indicate a slowdown in new loans being issued, or perhaps, more worryingly, an increase in loan charge-offs.
Charge-offs meaning the lenders are just writing off bad debt.
Essentially, yeah. Debts they figure they're not going to collect.
Okay, let's really dig into these delinquency rates then, because this seems to be where the potential trouble is brewing. And it can get a bit confusing, right, with terms like flow into serious delinquency versus the 90-plus days delinquency rate.
That's a critical distinction, absolutely.
Can you break that down for us?
Sure. So the flow into serious delinquency rate tells us the percentage of loans that newly became seriously delinquent. Usually that means 90 days or more past due during a specific time, like Q1 2025.
The new one's falling behind.
Exactly. For credit cards, the New York Fed reported that flow rate was 7.04% for Q1. The 90-plus days delinquency rate, sometimes called the stock rate, that's different. It gives you a snapshot of the total outstanding loan balance that is already 90 days or more delinquent at a specific moment in time.
So the total pile of existing bad debt.
Right, and that's the kind of figure Y-chart cited for auto loans, the 4.99%. And the New York Fed's own estimate for the credit card stock rate, in their Q1 report, it's around 4.8%.
Okay, 4.8% stock rate for credit cards from the Fed. But this is where a listener pointed something out to us. They saw a report, I think it was PYMNTS, citing a much higher number, 12.31% serious credit card delinquency Also supposedly from New York Fed data.
Yeah.
That's a huge difference from 4.8% or even the 7.04% flow rate.
Yeah, that discrepancy really highlights how tricky interpreting financial data can be.
So what's going on there?
Well, the 12.31% figure, as reported, is described as a 90-plus days delinquency rate. And yeah, it's flagged as the highest since Q1 2011. It's possible that figure focuses on a specific subset of cardholders.
Like maybe riskier borrowers.
Could be. Or maybe it uses a different calculation method, perhaps counting the number of delinquent accounts instead of the total delinquent balance. Or maybe it's even an annualized rate.
Hard to know without the details.
Exactly. Since the methodology isn't laid out clearly, comparing it directly to the Fed's published stock rate of around 4.8% or their flow rate of 7.04% is really difficult.
But the underlying trend seems clear.
The core message, yeah, it seems consistent. Credit card delinquencies are trending up. The Fed's own flow rate of 7.04% in Q1 2025 was higher than the 6.86% in Q1 2024. So regardless of which specific peak number you focus on, the direction is definitely concerning.
And it's not just about people who are severely behind, right? There's this other issue, borrowers just making minimum payments.
Oh, absolutely.
We've seen reports suggesting that could be, 11%? The Philly Fed called it a 12-year high recently. Some sources say even higher. You called this shadow delinquency. What do you mean by that?
Well, think of it this way. Borrowers only paying the minimum, they're essentially just treading water financially.
Barely keeping afloat.
Right. They haven't officially defaulted, so they don't show up in those serious delinquency stats yet. But their debt isn't really shrinking, especially with interest rates so high.
Yeah, average rates are what, 21, 22%?
Somewhere around there. So a huge chunk of that minimum payment just goes straight to interest. It makes it incredibly hard to actually pay down the principal.
So they're stuck.
Pretty much. And they're highly vulnerable to any kind of financial shock, job loss, unexpected expense. The fact that the Philly Fed saw a 12-year high in this minimum payment group late last year suggests there's a growing segment of borrowers on really precarious footing. It implies the official delinquency numbers might not even capture the full extent of the strain.
That's a sobering thought. And it's also quite worrying that younger borrowers, under 30, seem to have a particularly high serious credit card delinquency rate, around 10.3%.
Yes, that's a concerning figure. Starting out a career already facing that kind of debt pressure is tough.
Okay, moving on to auto loans. We saw that 4.99%, a serious delinquency rate, mentioned in some reports, a post-pandemic high. How does that compare with the Fed's direct data?
So that 4.99% figure from Y charts, citing the Fed, that's a stock measure, the 90-plus days rate. And it definitely reinforces this idea of increasing stress in the auto loan sector.
Higher than before, near pandemic peaks.
Exactly. Higher than the previous quarter, higher than last year, and nudging up towards those early 2020 levels. Now, the New York Fed's direct flow rate for auto loans in Q1 was 2.94%. That also showed a slight year-over-year increase.
Okay.
And their reported stock rate in the actual report is closer to 2.5%.
So again, slightly different numbers, but the trend is similar.
The trend is up, and the fact that this rise in delinquency is happening while overall auto loan balances actually decrease slightly, which, as we said, is where it points to some potential underlying issues.
Like what?
Could be softening demand for new cars, maybe lenders are tightening standards, or just more borrowers struggling to keep up with payments.
Got it. Then there's student loans. This seems to be where things got really dramatic in Q1.
Oh, absolutely dramatic. The jump in student loan delinquencies is, well, it's a direct consequence of policy changes.
The end of the payment pause.
Exactly. The end of the pandemic-era federal student loan payment pause and the fact that past due payments are being reported on credit reports again.
So what did the numbers do?
The flow into serious delinquency just skyrocketed. It went to 8.04% in Q1 2025. Compare that to just 0.80% in Q1 2024.
8% flow from less than 1%.
Massive jump. And similarly, the stock rate, the total percentage of student loan balances 90-plus days late, rose to 7.74% in Q1 2025. It was under 1% the previous quarter.
Wow.
So this is a huge policy-driven shift. It adds really substantial pressure to the financial system. And the Fed's data specifically highlighted high delinquency conversion rates for borrowers in their 30s and 40s.
They seem to be getting hit hard by the restart.
It appears so, yes.
Okay, and finally, mortgages. They're the biggest piece of the debt pie. Are we seeing any warning signs there?
Well, mortgage delinquencies are still relatively low compared to other loan types like credit cards or even auto loans now, but
But
there's a but. We are seeing an upward trend. The
yeah.
flow into serious delinquency ticked up to 1.22% in Q1 2025. That's up from 0.992% the year before. The stock rate is hovering around 0.80, 0.9%.
So low but rising.
Low but rising. And maybe of greater concern, the Fed report mentioned a significant increase in new foreclosure notations on credit reports that affected about 62,000 people in Q1.
Foreclosures are starting to kick up.
Starting to. And similar to student loans, it's the 30 to 49 age group that shows the highest mortgage delinquency conversion rates. So look, we're definitely not at 2008 crisis levels for mortgages. Not even close.
Thank goodness.
But these early indicators, this upward creep in delinquencies and foreclosures, they definitely warrant careful monitoring.
Okay, so looking at these trends across the board, credit cards, auto, student loans, even this slight increase in mortgages, it's hard not to draw some parallels, or at least think about past periods of stress, like 2008 or the start of the pandemic in 2020. How do things compare?
That's a really important comparison to make. Let's take credit cards first. If that 12.31% delinquency rate we discussed is accurate for a specific segment, well, that is approaching levels seen during the financial crisis. It would be the highest since early 2011.
A real red flag if accurate.
Absolutely. And even the Fed's own direct flow rate is elevated historically. For auto loans, that 4.99% stock rate for Q1 matches the early pandemic peak in March 2020, and it's higher than the long-term average.
Also concerning.
Definitely. Now, the student loan surge, as we said, that's unique. It's policy-driven, not like the slow build-up during the 2008 recession, but it adds significant systemic pressure right now.
And mortgages.
Mortgages, again, much lower delinquency than the 2008 peaks. But the recent upward trend and the rise in foreclosures, while starting from a low base, are things we didn't see just a year or two ago.
And the sheer amount of debt is also different, right?
Yeah.
Total household debt is much higher now than before 2008.
Precisely. The absolute number, $18.20 trillion, is way bigger than the peak back then, which was around $12.68 trillion. Now, the debt-to-GDP ratio might paint a slightly different picture, but the sheer volume of debt households are carrying is significantly larger.
And the economic backdrop is completely different, too.
Completely different. 2008 was, housing bubble bursting, subprime mortgage meltdown, banks failing, sky-high unemployment.
A very specific kind of crisis.
Right. 2020 was the sudden external shock. The pandemic, lockdowns, massive immediate job losses, but also met with unprecedented government stimulus and forbearance, which kind of artificially suppressed delinquencies for a while.
Okay, and now, Q1 2025.
Now we're dealing with persistent inflation, really high interest rates from the Fed's tightening, the end of all that pandemic support, and a labor market that's still pretty strong, but maybe showing signs of cooling. The drivers are just different this time around compared to both 08 and 20.
And you made a key point earlier. Unlike 2008, which was so housing-centric, we're seeing delinquency stress rising simultaneously across almost all consumer loan types now.
That, I think, is a crucial insight. It's not just one sector in trouble. The fact that credit cards, auto loans, student loans, and even mortgages are all showing rising stress suggests a more pervasive weakening of household financial health.
Broader issue.
A much broader issue. And critically, we don't have those massive government support programs that cushioned the blow in 2020. No more stimulus checks, no widespread forbearance. The end of that support, especially the student loan payment restart, leaves households much more exposed to these traditional economic pressures like inflation and high rates.
Okay, so let's break down those pressures. What are the main drivers pushing more people towards delinquency right now?
Well, it's really a combination of factors, all kind of interconnected. First, persistent inflation. It's been eating away at real incomes, eroding purchasing power. It just makes it harder to cover basic expenses and pay back debt.
People using credit cards to bridge the gap.
We're definitely seeing evidence of that. People increasingly relying on credit, especially cards, just to maintain their spending levels. Then number two, the high interest rate environment.
The Fed's actions.
Right. The Fed's fight against inflation means higher borrowing costs. That hits variable rate debt like credit cards and HELOCs immediately. And it makes new fixed rate loans, like mortgages and auto loans, much more expensive.
Squeezing budgets from multiple angles.
Exactly. Third, as we've discussed, the end of those pandemic support programs is huge, especially the student loan restart that was a major financial shock for millions of households, hitting their monthly budgets hard.
Okay. Inflation, rates, end of support. What else?
The labor market is key. It's been resilient, which has helped contain delinquencies to some extent. But any significant weakening, like rising unemployment or wages not keeping up, would almost certainly accelerate defaults.
So the job market is kind of the linchpin holding things together.
To a large degree, yes. We're also seeing that households generally increase their reliance on debt during and after the pandemic, and savings rates have come down quite a bit from those pandemic highs. So that financial buffer, that cushion, it's smaller for many families now.
Less room for error.
Much less room for error.
You also mentioned something interesting, a possible shift in how people prioritize paying their bills, with student loans and car payments maybe jumping ahead of credit cards.
That's a very real possibility, I think. Historically, homeowners usually prioritize their mortgage payment above almost everything else.
Keep a roof over their head.
Right. But now, with student loan payments mandatory again and needing a car to get to work being absolutely essential for many people, well, if you're financially stretched, you might make the tough choice to let the credit card bill slide first.
That could explain why credit card delinquencies are rising relatively sharply.
It could certainly be a contributing factor. And then overarching all of this is just the general cost of living squeeze. High housing costs, whether rent or mortgage payments, plus rising prices for essentials like food, energy. It just hits lower and middle income families the hardest.
And they're more likely to fall behind.
They're inherently more susceptible, yes. And we have seen some data suggesting that credit card delinquency rates are growing faster in lower income areas, which seems to confirm that.
Okay, so putting this all together, what are the potential consequences if these delinquency rates keep climbing for the broader economy? And what should, say, investors be watching?
The potential consequences are pretty significant. First, you could see reduced consumer spending. That's a huge driver of the U.S. economy, so any pullback there matters a lot.
Economy slows down.
Could slow down, yes. We could also see lenders getting nervous and tightening credit standards, making it harder and more expensive for everyone, consumers and businesses, to borrow money.
A credit crunch.
Potentially, or at least tighter credit. That, in turn, hits financial institutions. Banks, credit unions, they could see lower profits, need to set aside more money for loan losses, especially if they have a lot of exposure to consumer debt.
Okay.
And in a more severe scenario, if consumer credit health really deteriorates significantly, it could definitely contribute to a broader economic slowdown, maybe even tip us into a recession.
And the labor market is the key variable there.
It really is. As we said, a significant rise in unemployment would likely trigger a much faster acceleration of defaults across the board. These current increases are happening with relatively stable employment, which is notable.
Right. So what are the key indicators for investors, or anyone really, to monitor?
Okay, number one, keep a close eye on monthly unemployment data and initial jobless claims. That's your labor market health check. Number two, inflation reports, CPI, PCE. Are price pressures easing? That would give households some breathing room.
Makes sense.
3, Federal Reserve communications. What are they signaling about interest rates going forward? 4, future FRBNY household debt and credit reports themselves. Watch those delinquency trends and any changes in credit standards.
The source data itself.
Absolutely. Also, watch retail sales data for clues on consumer spending. And finally, keep an eye on bank earnings reports, specifically what they're saying about loan performance and how much they're reserving for potential losses.
That's a good list.
Right.
You made an interesting point earlier about maybe overshooting normalization. That we're not just returning to pre-pandemic levels, but potentially entering a phase of actual deterioration.
Yeah, I think that's a real possibility. The initial thinking was, okay, support ends, things go back to normal, meaning pre-2020 delinquency levels.
Right.
But what we're seeing now, especially in some of these reported numbers, like the 12.31% for credit cards or the 4.99% for auto loans, these exceed pre-pandemic norms. They're at multi-year highs.
So normal might have been left behind.
It suggests that this current combination, the sticky inflation, the high rates, the withdrawal of support, has created a genuinely more challenging environment than just a simple return to baseline. The old normal might not apply anymore, and risk models based on that old data might be underestimating the actual default risk now.
And you also mentioned the risk of a negative feedback loop starting.
Exactly. That's a serious concern. You get rising delinquencies. That makes lenders tighten credit, which restricts borrowing for consumers and businesses, which slows down the economy,
Wow.
potentially leading to job losses, which then causes more delinquencies.
A downward spiral.
It can become a self-reinforcing cycle. We're already seeing some signs of tighter credit access, and the Fed's own financial stability report talks about how this increased credit risk can pressure banks and lead them to pull back on lending. That's how these things can spread through the system.
Okay, so let's try to summarize this deep dive. It feels pretty clear we're seeing heightened risks in the U.S. consumer credit space.
I think that's fair to say, yes.
While mortgages aren't flashing 2008-style alarms, the broad increase in delinquencies, especially credit cards, auto loans, compounded by that student loan situation, definitely warrants serious attention.
Absolutely. And the path forward really hinges on those big macro factors: inflation, interest rates, and critically, the labor market. They'll determine how severe this credit stress cycle gets and how long it lasts.
So for you, our listener, the advice is really to pay close attention to those indicators we discussed. Watch how the credit markets evolve, carefully assess any related risks in your own situation or investments, and, be ready to adjust your thinking as things unfold.
Maybe consider, too, how all these different debt types, mortgage, auto, student, credit card, how they interact and potentially amplify the economic impact.
Yeah, that interconnectedness is key. And perhaps think about what strategies might be prudent for individuals navigating this kind of shifting landscape.
It definitely raises big questions about the resilience of American households right now and how that resilience, or lack thereof, will shape the economic story ahead.
Thank you for joining us for this deep dive.
Thanks for tuning in.
We'll see you next time.